Welcome to Learn CFDs, and today we're going to take a look at knowing your limits. Well, it's quite normal for traders to remember the extreme events. These extreme events is typically not what happens in the market most of the time. Yes, occasionally you get on a trade and it'll go really well and you make a lot of money. And these events tend to stick in the mind. Things like the flash crash that we had where the Dow fell 1,000 points in a day and then recovered by the end of the day. But those things will stick in our mind. 1987 crash, again, stuck in our mind, even though it's been 30 years since that last occurred. So even though these extreme events are relatively rare, we tend to remember them. In reality, the market most of the time simply trades in a range, and the extremes don't occur. So knowing the range of the market you trade can provide sound exit signals. We're looking at the market here. XJO, the Aussie 200, as many people know it, trades on a weekly basis about 170 points. This is what's known as the average true range. The normal range on a week is 170 points. The normal range on a day is around 65, on an hour is 17 points, and in 5 minutes it's just 5 points. The Nasdaq, 115 on a weekly basis, 55 on a daily, 6 points in an hour, and 1 point in 5 minutes. And you can see there BHP, the average true range, and also gold. Now if you're trading the market and you rapidly move to a daily value, so if let's say the XJO is up 60 points very quickly from the open, the chance of it moving further drops dramatically. This can be illustrated with the probabilities here. What we're looking at is the Aussie 200, and if the market has been up for 1 hour, what happens in the next hour? Now this shows a slight upward bias. The market's been up for 2 hours, then the market goes up again in the next hour. But as we get further out, we see lower returns. If the market's been going up for 5 hours, there's now a very good chance that in the next hour or two that the market will come off. Whereas back here, when the market's been going up for an hour, well, it's probably 5 hours before it comes off. It's quite a long way off. And if we look at the downside, we see a similar pattern playing out. If the market's been down for an hour, then we expect it to be slightly higher from here, but the strength really kicks in after 5 hours. But if the market's been going down for 4 or 5 hours, then we can see here that very quickly we're expecting the market to turn around. Now this is in direct contrast to how most beginners approach the market. They wait for the market to be moving in a direction, and when it's been moving in that direction for long enough, they get the confidence to jump on board. However, if the market's been moving any direction for, in this example, 5 hours, then the most likely thing to happen next is a reversal. And this brings us to cyclical thinking in the market. What happens is investors tend to think in straight lines. So if the market's going down, they think it will continue to go down forever. But in reality, that's not the case. If the market's heading down, we're more likely to have the market turn up, which we can see here. We're underestimating at the bottom of the move. During the center of the move, our estimates come in line with what the market is performing. But as we approach the top of the market, or top of the cycle, we overestimate the returns. We think that these returns are going to carry on and head higher. And we tend to overestimate through this time. So an example, at the top in 2007, most investors were not expecting the sharp drops that occurred because they were looking back at history. And the history said that we shouldn't be expecting these large drops. As a trader, you've got to turn your thinking around to start thinking cyclically. If the market's been moving up for 5 hours, then start to expect it to come down. If the market's been up for 5 days, then again start to look for the market to come off, not for the move to continue. And this is one of the dangers of chasing moves when you're trading, is that you end up chasing the market higher. A recipe for disaster. You can take advantage of this cyclical thinking by scaling in and out of your position. And scaling, what it does is it adds to the position as it becomes more likely that that position is going to go your way, and it reduces the position as it becomes more likely that the position is going to move against you. For example, CFD trading strategy, available at cfdtradingstrategy.com, it adds to the position here where these O's are, as the probability increases that the market's going to move higher. But as the market has moved higher, it then starts to scale out and reduce the size of the positions so that it gets out of the market and reduces the risk that the market rolling over will take away some of that profit that you've made. You can incorporate the scaling idea, scaling in and out of positions, to take advantage of the probability that the market's going to move one direction or another, and this can dramatically improve your trading results. I'd like to wish you successful trading.